Hello there, welcome back to the second lecture of Module 1 on Level 7 Diploma in Strategic Management and Leadership. So let's talk about strategic options, right? When you talk about strategic options, you can further break them down into three um, categories. One is how to compete, one is how you should grow, direction and momentum of growth, and then the third one is identifying a method of growth. How are you going to grow? These three are very important. Now, uh, in order to compete, you need to have some strategies. In order to compete, uh, what will help you compete in the market? So, what are the features and attributes you need to look at in an organization in order to compete? So, in order to compete, we got to talk about the qualities that is needed in an organization that will help you to compete. So first, let's talk about the Porter's generic strategies. Porter in 1980, right, identified the three um, general strategies that are fundamental source of competitive advantage. They are leadership, differentiation, and focus. So these are the three things that are needed in order to compete. If you don't have a good leader, then you're not in the right direction and things are going to fall apart. Next is differentiation. They're saying don't put all your eggs in one basket. That's for a reason. If you don't differentiate, then you cannot be in a you cannot become you cannot compete with other organizations. Not only that is that when let's say you have a misfortune in your organization and one product fails, if you put all your eggs in one basket, you're going to have the fall is going to be pretty prominent, and it won't help your organization recover. Next is focus. Focus, in other words, is where you're going to concentrate your attention, and so this is where this ties in with your goals. Short-term goals, long-term goals, and uh, and when you talk about focus, you're looking at products. You're talking about developing in-house skills. You're talking about enrichment of workers and skill sets. So to summarize and paraphrase this, you can break down competitiveness into three different areas: leadership, differentiation, and focus. Let's talk about more about the Porter's generic strategies: leadership, or cost leadership to be more specific. It's increasing profits by reducing costs while charging industry average prices. This in turn leads to increasing market share by charging lower prices while still making a reasonable profit on each sale. Um, so that's the logic behind it. In order to, you need a leadership that is aware of the cost and the current market value and the cost of manufacturing, and a good marketing team to uh, do this, because you will need to find a medium where your cost of manufacturing the product is um, is returned plus profit. If it's too high, then you won't have clients buying it. But if it's too low, then people might not respect your product. It won't set up a standard. So you got to find that um, fine line on where the what the price should be. Next is differentiation. Making your product and services different and more attractable than those of your competitors typically involves features, functionality, durability, support, and brand image. Um, Now, the key words in this current economy and the current culture you're looking for is functionality, uh, durability, support, and brand image. The same product could be sold by Gucci, and it could be like 5 times the price. It's just because of the image. Durability. If something is not um, resistant and it's not long lasting, then people are not going to buy it, Successful differentiation strategies includes good R&D department to, the R&D is important to understand and analyze why and how we can change a product and make it better, and the ability to deliver high quality products or services. um, Differentiation involves making our products or services uh, different from or and more attractive than those of your competitors. How you do this depends on the exact nature of the industry and the products and services themselves, but typically involve feature functionality and the durability, sport, and brand image. Um, Now, all of these should be something the customer values, so it's important to understand and know your customers as well. To make a success of a differentiation strategy, an organization must have a good R&D, the ability to deliver good high quality products, and last but not least, it's effective sales and marketing, and the benefits offered by the differentiated offerings. Large organizations usually pursue a differentiation strategy that helps them to stay agile with the new product development processes. Otherwise, they risk attack on several fronts by competitors pursuing focused differentiation strategies in a different market segments. Porter's generic strategies focus used by companies in niche markets build strong brand loyalty, and it makes market segment less attractive to competitions and competitors. Companies that use focus strategies concentrate on a particular niche market, and by understanding the dynamics of that market and the unique needs of the customer within it, develops uniquely low cost or well specified products for the market. Because they serve customers in the market uniquely well, they tend to build strong brand loyalty among the customers. This makes their particular market segment less attractive to competitors. Selecting a strategy. Have one clear strategy. Make sure that the chosen strategy is sustainable, relevant to current and future market needs, and that it's defensible to any unstable factors that we're not aware of. Um, some organizations have more than one strategy, which makes it very difficult. So, regardless of the size of your organization, you should have one clear strategy rather than having a mix of it. If the organization is unable to move forward with one strategy, we use this term stuck in the middle to describe them. After selecting a particular strategy, the organization needs to make it sustainable. For a strategy to be sustainable, the following criteria needs to be met. One is relevant to current and future market trends. Defensible, which means barriers for coping, should be a skill-based and asset-based. So that's why when you're talking about skill-based and asset-based, you got to invest in your employees and make sure that they have the skill set and the resilience that you need to overcome any market instability. Next is direction of the growth, or you can talk about momentum of the growth. The Ansoff matrix, what does this do? It kind of guides us on how we want to talk about direction of growth. One is the first is suggest that there are two approaches to developing a growth strategy. One is product growth and market growth. What is product growth, right? It's varying what is sold, offering a few variations or different products. And next is who is sold to the market growth, increasing the market share of your product. That is called the market growth. When combined, you deliver four options, each with a differing level of risk. So using the Ansoff matrix, we can divide growth into four different sections. One is let's talk about the products. You can divide them into existing and new, and we could do the same thing with markets as existing and new. And it was created by Igor Antsov in 1960, and it's a good kind of a framework in which we can put the market and the products into and isolate them, and offers a good visual representation. So the next section is growth. Growth could be divided into three sections. One is organic growth, which involves natural growth that is achieved by reinvesting profits in new assets for greater income and improving productivity to increase the bottom line. The one after that is acquisitions and mergers. This is growth achieved by buying another company. And the last one is joint ventures. This is where growth is achieved by joining with another company or by expanding through franchising. Advantages of organic growth. When you grow your business through strong management and effective planning, you know your business inside out, and you can move quickly to take advantage of the changes in the marketplace. And you can also experience in the satisfaction of seeing your vision come to fruition. You also have the choice of growing your business at a rate that is comfortable for you. Instead of merging with another company or buying one, you can sell your business when it's mature, which can create profit for you. What are the disadvantages of inorganic growth? Is organic growth may result in limited resources for growing your business. The market share will not allow growth beyond a certain point. Growing a business from the startup stage means constantly struggling to make the organization have positive cash flow in order to pay bills, payroll, as well as finding ways to grow sales. Um, Inorganic growth advantages and disadvantages. Advantages of inorganic growth. Inorganic growth immediately expands your assets, your income, and your market presence. You'll have a stronger line of credit because the combined value of the two businesses. You'll also benefit from the added expertise from personnel at the new business. Disadvantages of inorganic growth is you'll have to expand your management capabilities dramatically when you join forces with another business. You'll suddenly have many more employees or more assets to monitor, use, and dispose as your business needs and changes. In addition, you may grow in a direction that you didn't anticipate. In effect, the focus of the second business can take over the vision you had when you started the business. Evaluating strategic options. How do you evaluate them, right? You have to look at suitability, acceptability, and feasibility. In a paper written by Whittington, Scholes, and Johnson, they argue that for a strategy to be successful, it must satisfy the three criteria. Suitability is whether the options are adequate response to the organization's assessment of its strategic position. Next is acceptability. Consider whether the options meet and are consistent with the organization's objectives and are acceptable to the stakeholders. Feasibility assesses whether the organization has the resources it needs to carry out the strategy. Feasibility of alternate options. You can break that down into further three options. Tools to evaluate feasibility that can be broken down into cash flow analysis and forecasting, break-even analysis, and M model. Let's talk about M model. Machinery, management, money, manpower, market, materials, and makeup. Machinery, it's what demands will the strategy make on production in terms of capacity and production systems. Management, is existing management sufficiently skilled to carry out the strategy? Money, how much finance is needed and when can we raise this? Is the cash flow feasible? Manpower, what demands will the strategy make on human resources? How many employees are needed? What skills will they need and when do we need them? Markets, is our existing brand name strong enough for the strategy to work? Will new brand names have to be established? What market share is needed for success and how quickly can we achieve this? Next is materials. What demands will the strategy make on relationship with suppliers? Are changes in quality needed? Last one is makeup. Is the existing organizational structure adequate or will it need to be changed? So these are the, when you take the M model, these are the subsegments and these are the questions that we have to know and answer. Next is talk about cash flow analysis. The financial feasibility of strategic options can be also assessed using cash flow analysis. Cash flow analysis involves all listing out all the possible cash outflows and cash inflows for each strategy and arriving at a net cash figure. People often mistakenly believe that a cash flow statement will show the profitability of a business or a project. Although closely related, cash flow and profitability are two different things. Cash flow statement shows liquidity, while an income statement shows profitability. Break-even analysis. Break-even analysis, it's used to identify the break-even point, the point at which the total sales revenue equals total cost. Anything beyond this profit is considered, profit, because this, if you take into account the cost of production, overhead costs, and other expenses, such as getting up to the point of producing the product, the overall expenses. So the point at which you recoup that is called break-even point. Now you can further divide that into a break-even point for a product, or you can consider break-even point for each individual unit sale price, or you can consider it as a gross sales volume. What is break-even analysis, right? It's an analysis that is conducted to identify the break-even point. The break-even point, it is a point which is very vital to new companies, new startups. This is a question you got to ask yourself in terms of strategy. What would be a break-even point? Or you can also put that in years. How many years would it take us to reach the break-even point? So this is, you can talk about it in terms of time, monetary means, reimbursement, or how long would it take us to recoup it. The term contribution is used, as it literally means, is the amount which contributes to cover the fixed cost. Now, looking at the break-even analysis in a graph visualization format, the units sold are on the x-axis, the revenue is on the y-axis. The cost is the brown line and the revenue is the blue line. The point of intersection where they meet is what's called the break-even point. Anything beyond the break-even point is called profit. Anything below the break-even point, if you sell below that, it's called loss. So at minimum, the cost of your product or merchandise or service, depending on the industry, should be set at the minimum of break-even point to even consider success. Example of a break-even analysis is this. Assume that a small footwear manufacturing business has an estimated fixed cost of $100,000 consisting of a lease, property tax, and salaries. The variable cost of producing a shoe is $100 per unit. This pair of shoes is sold for $500. In this case, the break-even point for the business pair of shoes will be break-even quantity would be 100,000 divided by $500 minus $100 gives you $250. Therefore, with the current fixed and variable costs and selling price, the footwear maker will need to sell 250 pairs of shoes to break even or to get back the money and the indirect cost and the overhead cost to call it a profit. If he did not sell 250 pairs, if the company fails to sell 250 pairs of shoes, then it's most likely going to be a loss. Introduction to risk. This is a very important question and a situation that most businesses face. Business um, are are highly volatile environments, and it's therefore necessary for decision makers to predict the future accurately before making financial decisions. In a dynamic economy, the likelihood of achieving the expected outcome is doubtful. At times, certain predictions may not be realistic. In order to ensure successful strategic development, it is essential to be aware of the risk and understand the difference between risk and uncertainty. What is risk? Risk can be defined as future uncertainty about deviation from expected earnings or expected outcome. When making strategic decisions, risks are inevitable. The risk is a probability in which the actual return on investment is lower than what is originally expected. Uncertainty refers to the difficulties in measuring or estimating the range of possible outcomes. It can be argued that uncertainty cannot be managed while it is still possible to manage risks. Risk management. Risk management is the identification and management of risks likely to have a material impact on the organization's ability to achieve its mission and objectives. Risk management includes identification and analysis, prioritization, response planning, resolution, monitoring, and reporting. Risk identification, that includes three sections by itself. It includes risk breakdown structure, brainstorming, cause and effect diagrams. Risk breakdown structure lists all the possible risks that are associated with the strategy and categorize them. Brainstorming, it includes identifying and discussing the potential risks. Cause and effect diagrams, the Ishikawa fishbone analysis looks at a range of risks and the potential impacts on the project. So the risk assessment matrix. The risk assessment matrix is a tool that could be used to evaluate and identify risks. It measures the level of risks by comparing the likelihood of occurrence, the magnitude of impact. Decisions which involve the risks that are highly likely to occur and can create a high impact on the organizations should be avoided. Now, when we look at this risk matrix, when you go from left to right, the severity of the impact can be seen. All the way in the left, there's low, negligible, and all the way in the right, it's severe. When you go from bottom to about top, very unlikely to very likely. So anything in the upper portion of the matrix is not really helpful, because anything in the upper right hand side is not helpful. Anything within the first two rows of negligible, minor, and then first two rows going down is okay and is acceptable. Anything from moderate going down to the right is going to impact the organization very much. So the first two rows, looking at it vertically, and the first two rows looking at it horizontally from bottom up, those are the acceptable, I would say, risks that an organization can take. Now, justification for selected strategies and or the SAF strategy model. Johnson and Scholes provided a useful framework for justifying selected strategies. The SAF um, strategy model, it includes the following components: suitability, whether or not the strategy will do what the company wants it to do; acceptability, which is the extent to which the choice fits in with the stakeholders; and then last is feasibility, whether the organization has the resources it needs to carry out the strategy. The SAF strategy model. Let's talk about suitability. Probably is the most important factor in the SAF strategy model. As an option, suitability is the key to whether or not the strategy will do what the company wants it to do. Suitability is usually assessed in a number of different criteria that is specifically important to the business or company, such as the environment suitability, expectations suitability, and capability suitability. The suitability of the selected strategy can be justified by answering the following questions. Does the strategy exploit the company's strengths? How far does the strategy overcome the difficulties identified in the analysis? Does the option fit in with the organizational purpose? Acceptability. Acceptability is essentially about assessing risks or risk and return, and is strongly related to stakeholders' expectations. The selected strategies can be justified against the following questions. How will the strategy impact shareholder wealth? How will the finance risk change? Will the strategy be acceptable in an organizational environment? What effect will it have on the capital structure? Gearing or, the last question, what effect will it have on the capital structure? What it refers to here is gearing or share ownership. Last one is feasibility. The chosen strategy should also be justified by assessing whether the organization has the resources it needs to carry out the strategy. This analysis can be presented using the M word, which we talked about earlier, which is machinery, management, money, manpower, markets, materials, and makeup. So let's talk about strategic plan. What is a strategic plan? It is a roadmap to achieve the organizational goals and objectives. It's important to remember when the strategies are being formulated for an international business, due consideration should be given to the analysis of the external environment depending on the country's macro factors. Approaches to strategic planning, they could be divided into three sections: resource-based, market-based, and emergent. Resource-based. According to the resource-based approach, corporate success is not only the realization of visions, aspirations, and mission, it's the result of careful appreciation of the strengths of the organization and the environment within which it operates. Corporate success derives from a competitive advantage, which is based on distinct capabilities, which is most often derived from the unique character of an organization's relationship with its suppliers, customers, or employees, and which is precisely identified and applied to relevant markets. Resource-based approach. According to the resource-based approach, strategy should be formulated to achieve a competitive advantage by appreciating the organizational capabilities and industry key success factors. Now, an organization capabilities are further subdivided into three sections: tangible, intangible, and human. Tangible are like financial and physical. Intangible is reputation, culture, technology. And then last is the human, which is the specialized skills and knowledge, communication and interactive abilities, motivation, and leadership. Market-based approach. This often focuses on analyzing the environment and resource capabilities of the organization and planning to fit the organization with its environment. This approach is often used by the organization with a strong balance sheet, value created through growth. The emergent approach. Now, according to this method, strategies are developed without any prior planning. Instead, the organization focuses on adapting to the changing environment instantly. In this approach, instead of meeting a deliberate plan, company needs to develop strategies through learning, adjustment, experimentation. Here, formulation of strategy runs parallel to that of implementation. This model motivates learning, which focuses on the value of knowledge as a core organizational competency. An emergent approach leads to more creative and responsive strategy making, which is well suited to the hyper competitive and unpredictable environments of today. It also reduces resistance to change as it allows time to build employee support to strategic making. This is a good diagram where you have your intended strategy, your realized strategy, in the middle is a deliberate strategy. Then you have your emergent strategies, which work towards the realized strategy. Now, develop a strategic plan, right? There are steps that are involved in it. First is to identify the organization's vision and mission. Next is to develop an organizational objective to translate the vision and the mission into actionable goals. Next is to conduct a thorough environmental audit to understand the current context, strengths, weakness, opportunities, and threats. Next is to develop a strategy that's both competitive and growth strategy. That includes four things, which is identify strategic choices, evaluate strategic options, and justify selected strategies. Next is to create an implementation of plan, which includes timeline, budget, and risks. And the last one here is to set monitoring and control measures. Now, again, we are revisiting this idea of vision and mission because it's very important. Vision defines what the organization wants to be. The vision states answer to the question, where do we want to go? Mission defines the overall purpose of the organization, its scopes, boundaries. It sets the philosophy and culture behind the basic organization functions. So, in other words, vision is where the organization wants to go. Mission is what's the purpose of the organization. So they are both interrelated. Mission defines the actual reason for existence of the organization. And then vision is what it's doing and what it's trying to do as an existing organization based on those mission values. Next is part of developing a strategic plan is to develop organizational objectives. This includes there are a series of steps that's identified in order to develop organizational objectives. That's objectives are quantified statements on what an organization intends to achieve. They should convert the mission of the organization onto specific targets, which direct the activities of the organization, and can be also used for measuring performance. An objective is broader than a goal, and one objective can be broken into a number of different goals. So you have mission, objectives, goals, and organizational objective should be SMART. What does SMART stand for? SMART stands for specific, measurable, achievable, realistic, and time-bound. The next slide is how do we conduct an audit, an environmental audit. You can use the macro pestle analysis. You can have or the micro Porter's 5 force theory, or the internal BCG matrix and GE matrix. and and then the findings of these could then be transitioned into or analyzed using a SWOT analysis. The next lecture for module 1 of the level 7 is coming up. We'll continue there.